No, sir, it's live.
Okay, fine. Chalo. Okay, great.
So, good afternoon, everyone. We welcome you all to the webinar organized by the Banking, Financial Services and Insurance Board of the Institute of Cost Accountants of India on the topic Analysis of Monetary Policy Statement 2024-25. And we are really privileged to have with us as our eminent speaker today, Sri Govind Gurnani, sir. He's the former AGM RBI. We welcome you, sir. We also have with us, thank you, sir. We also have with us our chairman, sir, CMA Chitturanjan Chattopadhyay, sir, CMA Dr. Aditi Dasgupta, Madam Joint Director, ICMEI, and other officials of our BFSI team. So we welcome all of you. So just before we start, we are playing the Institute anthem, and then we will continue with the program.
Okay.
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतङ्गमय मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय ॐ शान्ति शान्ति शान्ति
Okay, So now I would request our chairman, sir, CMA Chitturanjan Chattopadhyay, sir, for his address. Sir, please.
Thank you, Madam Injakshi, for your. You have started the program very well. So the Institute's anthem. I welcome Mr. Gurnani, Govind Gurnani, who is a prolific banker, central banker, of course, and he's a avid reader and he's an avid learner, and he is also having tremendous knowledge in the financial sectors. And let us all welcome our Govindji in this particular forum of the Institute of Cost Accountants of India, which is known as ICMAI. I welcome all my participants here who are participating in mass in this particular program on this very important topics, the discussions on monetary policy 2024-25. And the BFSI board, ICMA, is continuously working for the knowledge growth of the members and the students. And in its endeavor, we are organizing a series of webinars on every alternate Fridays from 4 to 6 p.m. Today's webinar will be conducted, as I have told you, the Govind Gurnani ji, former AGM, Reserve Bank of India. Today's topic is the analysis of monetary policy statements for the year 2024-25. Friends, we know that in the last monetary policy committee meeting by Reserve Bank of India, it has been kept the rates of bank rate, repo, reverse repo unchanged. It is done as a measure of policy neutral, and hopes are built that in the third quarter the rates may come down as anticipated. It would trigger another bout of growth with lower cost, and it would give a fillip to the economy with such measures we expect. The Fed has also continued that, and they have committed also that they would also go for 4 rounds of rate cuts in USA, which would bolster the economy and drive demand and growth. As we all know that RBI's monetary policy enables the economy to arrest inflation and supply of money. We have seen that effective monetary and fiscal policies are required for harnessing the growth and developments in the economy. We have also seen that the economy has increased their growth rate if effective policies are implemented by the government of India through fiscal and monetary policy. And the GDP forecast has been kept at 7%, which is very conservative considering the relief it would get with decreasing interest rates in the last 2 quarters. And these are all our, we are reading between the lines of many, expert economists of the country. But from the BFSI board, we are always looking for the expert opinion and the nitty-gritties, which our CMAs will be definitely benefited from this sort of program. And we also like to inform you that we are also going to launch the FinTech course very shortly. That's an endeavor from the council to remain more and more, relevant in this digital disruptions age. And you'll be very happy that your BFSI board has come out with the second enlarged editions of the infrastructure financing book, which is titled as Aid Memoir on Infrastructure Financing. Friends, we have got many more into our bucket, but it is only your participations, your wisdom, it will help us to grow and to move forward. Council will always be very much proactive with your thoughts. Whatever thoughts you have, please share with us, and we shall be very happy to take this. And I am sure today's session for many of us CMAs will be a very enriching session with learning, unlearning, and relearning. I again welcome you all in this particular day, and I think after this program, you will be all definitely giving your feedback to us so that we can more and more have an enjoyable session for you. Thank you.
Thank you, sir. So I would like to now introduce our eminent speaker, Mr. Govind Gurnani. Sir is former Assistant General Manager, and he is a banking veteran with 35 years of experience in the service of Reserve Bank of India, a regulator for all banks. His MBA in Banking and Finance and a Certified Associate of Indian Institute of Bankers. During his stint with the RBI, he has worked with RBI governors like Dr. Bimal Jalan, Dr. Y.V. Reddy on various assignments. His areas of interest and expertise are finance, monetary policy, financial audit, and risk management. Sir writes columns for various banking and finance magazines and is active on LinkedIn. We welcome you, sir. So
Thank
it's an
you.
honor and privilege, sir, to have you with us today. So requesting sir now for his presentation. So please, over to you.
Thank you, Indrakshi. Thank you for your kind words, distinguished participants. Good evening. At the outset, I am grateful to BFSI Board of ICMI for inviting me and giving me this opportunity to share a few thoughts on this very pertinent theme of banking and financial sector. Before I move to the main subject of the webinar, it is a matter of great satisfaction that today our country's GDP growth is robust, inflation is moderating, the financial sector is stable, the external sector remains resilient, and the forex reserves are at an all-time high. Let me repeat for that today our country's GDP growth is very robust, inflation is moderating, and the financial sector is stable. The external sector remains resilient, and the forex reserves are at an all-time high. Coming to the main topic of the today's webinar, let me inform you as to why I have chosen this subject for you. First, since the Monetary Policy Committee of the RBI has recently made its deliberations on the monetary policy for financial year 2025, so it will be proper to analyze its decisions and to share my point of view with you. The second reason for selecting this subject is that the subject of monetary policy is interesting and familiar to me, as during my 35 years of experience with RBI, I had the opportunity of working in the monetary policy department for a couple of years. In tune with the theme of the webinar, I would like to briefly share the agenda for today. First, I will take you through the what is monetary policy, objectives and the types of monetary policy. Then I will take you to the who are the members of monetary policy committee and what are its functions. I would then proceed to talk about the decisions and deliberations of the monetary policy committee at recent meet in the I'm sharing my screen. Sorry. Next, I will talk about the factors that the RBI has taken for projecting real GDP growth as well as inflation in the Indian economy. After that, I will talk about the various developmental and regulatory policy measures which the RBI has proposed at the MPC meet and its implications. In the end, I am going to express my thoughts on the reduction in policy repo rate in the near future. Is my screen visible?
Yes, sir.
Yeah.
Sir, it is visible.
Yeah. One. So now, what is monetary policy? It refers to the steps taken by the country's central bank to control the money supply for price stability, economic stability, and the financial stability. So, the steps taken by country's central bank to control the money supply for price stability, economic stability, and the financial stability. In the simple terms, the monetary policy refers to the use of instruments within the control of the central bank to influence the level of aggregate money supply in the economy to control the inflation while supporting growth. Now, what are the instruments which the RBI is using to influence the level of aggregate money supply? Mainly, there are three instruments. One is repo rate, that is the interest main policy rate. Second is the reserve requirements. And third is the open market operations, that is buy and sell of the securities. These are the main three instruments which are within the control of the central bank to influence the level of aggregate money supply in the economy to control the inflation while supporting the growth. Now, this monetary policy is reviewed 6 times in a year at bi-monthly intervals. Now, who are the members of monetary policy committee? There are 6 MPC members. 3 are the external members and 3 are the internal members. External members are the Dr. Shashanka Bide, who is senior advisor at National Council of the Applied Economic Research in Delhi. Dr. Ashima Goyal, who is professor at Indira Gandhi Institute of Development Research in Mumbai. Jayant R. Verma, who is professor at IIM Ahmedabad. So all these 3 are the external members of the Monetary Policy Committee. There are 3 internal members also, and that is Dr. Rajiv Ranjan, who is Executive Director of the Monetary Policy Department at RBI, Dr. Michael Patra, who is Deputy Governor in charge of the Monetary Policy at RBI, and Sri Shaktikanta Das, who is chairing this Monetary Policy Committee and who is the Governor of the RBI. And now, what are the main functions of this Monetary Policy Committee? The members of Monetary Policy Committee sets the policy repo rate and decides about the stance, that is the future direction of the monetary policy. And they also gave the rationale for their decisions by looking at the inflation and the real GDP growth. On this, they are also giving the rationale that why we have come to this decision of the policy repo rate and what is the direction for the monetary policy. Now, coming to the main objectives, there are 3 main objectives of the monetary policy: price stability, economic growth, and the financial stability. Under price stability, the RBI targets a specific inflation rate that he has to achieve, that is 2% to 6% range is given by the government that you have to achieve the medium-term target of the 4 consumer price index inflation of the 4% within a band of ±2. That is 2 to 6% we have to maintain under price stability. Economic growth, under economic growth, we have to ensure that the adequate credit availability for the businesses and individuals are available. And third objective is the financial stability, under which RBI aims to build a financial system that is strong enough to promote the economic well-being, avoid crisis, and protect the interest of the citizens. There are mainly 2 types of monetary policy, that is the expansionary policy and the contractionary policy, or the dear money policy. Under expansionary policy, the efforts are being made to increase the money supply and interest rates are kept low for economic growth during economic downturns. Now, what is expansionary? That the efforts are made to increase the money supply, and in this policy, interest rates are kept low for the economic growth. Like during COVID times, we have kept the interest rate at the 4%, and we have tried our best to increase the liquidity in the market. Under second contractionary policy, the RBI increases the interest rates and tightens the money supply to control the inflation in the economy. When inflation is increasing, at that time, RBI also increase the interest rates and tighten the money supply to control the inflation. So these are the 2 main policies, expansionary and the contractionary. Now, I know there are a lot of numbers on this slide, so I will explain you one by one. We will start with the repo rate. Repo rate is, at the meeting, the MPC left the benchmark policy repo rate unchanged at 6.5% for the 7th consecutively, which is effective since February 2023. Now, repo rate is the main policy rate, or it is called as the base rate for other rates of the monetary policy under the liquidity adjustment facility framework. Other 3 rates main are standing deposit facilities, that is 6.25. Under standing deposit facility, it is a non-collateralized facility for parking funds with the RBI by the banks, and it is given for only overnight. So this rate is always kept at 25 basis less than the main repo rate, that is 6.5. So standing deposit facility will be always at the 6.25, that is 25 basis points below the repo rate. The next is the marginal standing facility, is at the 6.75. It is the rate at which the banks can borrow the funds from the RBI for the overnight. So these are the main 3 rates: repo rate, standing deposit facility rate, and the marginal standing facility rate. Fourth is the bank rate, that is 6.75%, and it is also related to the main repo rate, that it is always kept 25 basis points above the repo rate. At present, the repo rate is 6.5%. The bank rate will be kept at the 6.75%. And the reverse repo rate is the 3.35%. Reverse repo rate and the standing deposit facility both are the same, but in this, standing deposit facility is a non-collateralized facility, whereas under reverse repo rate, the banks can come to the RBI for parking funds, but they will also get the collateral from the RBI, and the rate is kept very low. It is kept at 3.35, but it is not related to it is not based to the report. This decides by the RBI itself, and for this it is not going to the MPC that whether we can change this reverse repo rate or not. So in the RBI's revised liquidity adjustment facility framework, the scheme of lending funds to the banks at fixed repo rate has been withdrawn, and the banks can borrow the funds under marginal standing facility for overnight only. So repo rate is only as a worked as a base rate. The main rate is the MSF, on which the banks can borrow the funds in case of emergency from the RBI for overnight only. And it is a ceiling rate. It is always kept at 25 basis points above the policy repo rate, whereas the SDF rate is considered as floor under the liquidity adjustment facility corridor, rate corridor, and it is kept at 25 basis points below the policy repo rate. The difference between the rates of MSF and the SDA is considered as policy rate corridor. The stance of monetary policy. The stance of monetary policy is to remain focused on withdrawal of the accommodation to ensure that inflation progressively aligns to the target while supporting growth. Now, in the recent times, the interest rate prevailing in the central banks of the advanced economies are as follows. Now we are coming to the interest rate which are trending in the other central banks currently. In the Fed Reserve, it is 5.25 to 5.50%. This rate has been kept on hold for last 10 to 12 months by the US. Then second is the Bank of England. Its rate is 5.25%. They have also kept the rate this on hold for longer period like our India. And European Central Bank has kept its rate at 4.50. They have also kept the rate on hold to tame the inflation, to keep the inflation aligned with their target, and the RBI has kept at 6.50. So for all these four economies have kept their policy rates on hold to ensure that their inflation is aligning with their targets. Another is the Bank of Japan. It has increased the rate by 10 basis points in March only, and earlier it was minus 0.1 to 0%. Recently they have increased by 10 basis points. So now rate is 0% to 1%. They are keeping the rate in the range. And another central bank is that is Switzerland's Swiss National Bank, 1.5. They have also reduced the rate by 0.25% recently in the March. And because they have seen that their inflation is declining, so they have kept reduced the rate by the 0.25%, and now their rate is 1.5%. Another is the Brazil's central bank. They have kept rate at presently 10.75 as on March 24. They have reduced this policy rate by 300 basis points from the August 23 onwards. Before August 23, it was 13.75%, but slowly they have reduced, and now the rate is 10.75% as on March 24. Last is the Central Bank of Chile, which is the 6.5%. They have just reduced in this month only, in April 24, and they have also started reducing the rates from July 23. They have reduced the rate by 475 basis points. Their previous rate was 11.25% in October 22, but from July 23 onwards, they have reduced the rate, and now the current rate is 6.5% in April 24. Their inflation in the Chile is 4.5%, but the main policy rate is 6.5%. So actual real rate is only 2% only. Thus, as regards the inflation, as regards the now real GDP growth, we are now discussing the what is the real GDP growth actual. The second advanced estimate placed real GDP growth at 7.6% for 2023-24. This is the third successive year of the 7% or higher growth. Our GDP was expanded by 9.7% in 2021-22, whereas it was 7% in 2022 and 23. So for 3 successive years, our GDP growth is 7%. Last year, it was 7.6% for the 2024. Now, what are the estimates? What are the projections made by the MPC for this real GDP growth? And what factors they have considered to arrive at this real GDP growth? So, for project, the MPC has projected the real GDP growth for the year 2024 is at 7%. They have also given the breakup for this projection quarter wise. For the quarter one, it is projected at 7.1%. For quarter two, 6.9%, and for quarter three, it is 7%, and for quarter four, it is 7%. Same, and the risks are evenly balanced. Now, what are the factors that the MPC or the RBI has considered for this arriving at the real GDP growth estimates? They have considered 4 factors mainly. That is the bright outlook for the agriculture and rural activity, rise in private consumption. Third is the fixed investment and external demand for goods and services. Now let me explain you this in detail that how our agriculture and rural activity is bright. Going forward, the outlook for the agriculture and rural activity appears bright with good Rabi wheat crop and the improved prospects of Kharif crops due to the expected normal southwest monsoon. Rise in the private consumption. RBI says that the strengthening of the rural demand, improved employment conditions, and the informal sector activity, moderating inflationary pressures and sustained momentum will boost our private consumption. Third is fixed investment. The prospects of fixed investment in India will remain bright thanks to these 4 factors. That nowadays there are increased investment by the private sector in the capital expenditure projects. Earlier they were not doing the investment in very muted response were given by the private sector, but now they have increased the investment in the CAPEX projects. Our government is also investing more and more in the CAPEX projects. Robust government investment is done by the CAPEX projects in these budget estimates. Our balance sheet, banks' balance sheets have become very healthy. Also, the balance sheet of the corporates have become healthy. And in manufacturing industry, capacity utilization has been rising. So, why our fixed investment prospects are high? That is due to the increased investment by the private sector in the CAPEX projects, robust government investment in CAPEX projects, healthy balance sheets of the banks and corporates, and fourth is the rising capacity utilization. Now, the 4th factor which the RBI has considered is the external demand for goods and services. Why there is increase in the external demand for goods and services nowadays? That is improving global growth and trade prospects and rising integration of the global supply chains are expected to increase the external demand for our goods and services. Now, are there any risks to the above outlook for GDP growth? Yes, the RBI says headwinds from geopolitical tensions and the increasing disruptions in the trade routes are going to pose risk to this outlook. Regarding the inflation, the RBI says that the headline inflation was eased to 5.1% during January and February 2024 from 5.7% in December 2023. At one time, it was 7.8% in 2022. But now it has come down in December at 5.7%, and in last 2 months, that is January and February, both months, our headline inflation was eased to the 5.1%. Now let us discuss consumer price index inflation forecast done by the RBI in the recent monetary policy statement. RBI says that with the assumption of the normal monsoon, CPI inflation for the 2024 is projected at 4.5%. They have also given the projections of the inflation quarter-wise. Quarter 1 at 4.9%, quarter 2 3.8%, quarter 3 4.6%, and quarter 4 at 4.5%. For all these 4 quarters, the risks are evenly balanced. Are there any risks to this inflation? Yes, food price uncertainties and frequent adverse climate shocks continue to pose risk to the inflation, and continuing geopolitical tensions also pose the upside risk to commodity prices and supply chains. So our inflation is not coming under control due to this volatility in the food prices, as well as the geopolitical tensions also poses the upside risk to this commodity prices and the supply chains. Now I am discussing as to how this inflation and growth conditions has led the RBI to keep the policy rates and the stance of the monetary policy unchanged. Means how this affects to the decision of the MPC, these two, inflation and growth conditions. RBI says that in its monetary policy statement that the inflation has no doubt come down significantly, but it is still remaining above the 4% target. Food inflation continues to exhibit considerable volatility in pending the ongoing disinflation process. RBI's ongoing effort is to ensure fuller transmission of the policy actions and anchoring of household inflation expectations. The strong growth momentum in the economy has provided the elbow room to RBI to focus on price stability. Let me repeat. RBI says that inflation has come down significantly, but it is still remaining above the 4% target. Our food inflation continues to exhibit considerable volatility impending the ongoing disinflation process. RBI's ongoing effort is to ensure fuller transmission of policy actions and anchoring of household inflation expectations. The strong growth momentum in the economy has provided the elbow room to the RBI to focus on the price stability. In respect of achievement of the inflation target so far, the RBI governor says in his monetary statement that 2 years ago, around this time, when CPI inflation had peaked at 7.8% in April 2022, the elephant in the room was inflation. And the elephant has now gone out for a walk and appears to be returning to the forest. But the RBI would like the elephant to return to the forest and remain there on a durable basis. So currently, inflation is no doubt reducing, it is declining, but it is still moving in the forest only. It is moving outside the forest. It is going towards the forest, but it has not yet reached to the forest. And RBI wants to ensure that this elephant, that is inflation, should return to the forest and remain there on a durable basis. Not like that in one quarter it comes down to beyond less than 4% and then again goes out for a 5% or 6%. That RBI does not like. In other words, it is essential in the best interest of the economy that CPI inflation continues to moderate and aligns to the target on a durable basis. RBI wants this target on a durable basis before it go for the rate cut in the monetary policy. Till this is achieved, till the 4% target is achieved, RBI's task remains unfinished. Presently, the inflation is at 5.1%. No doubt it is under our comfortable zone of the 2 to 6%, but the RBI wants to achieve 4%, and RBI wants this target to remain 4% on a durable basis. Currently, it is still out of forest. It is moving outside the our target. So RBI wants to ensure that before going for a rate cut. On the external financing side, India's foreign portfolio investment flows has seen a significant turnaround in 2023-24. Net FPI foreign portfolio investment inflows stood at USD 41.6 billion during 2023-24, as against the net outflows in the preceding 2 years, which were USD 14.1 billion in 2021-22 and USD 4.8 billion in 2022 and 23. So it can be seen that in 21-22 and 22-23, it was net outflows, not the inflows. But in that last year, we have got the inflows from the foreign portfolio investors, that is now 41.6 billion. India's foreign exchange reserves reached at an all-time high of the USD 45.6 billion as of March 29, 2024. During the first 3 quarters of the last year, India's current account deficit narrowed significantly. It was due to trade deficit along with the robust growth in services, exports, and strong remittances. India's exports have grown at the healthy pace in Q4 of the last year. Now we are turning towards the developmental and regulatory policy measures that the RBI has taken relating to the financial markets, regulations, payment systems, and fintech. There are 7 measures that RBI has proposed in its monetary policy. We will take this as one by one. First measure which RBI has proposed to take is trading of sovereign green bonds in IFSC. Currently, foreign portfolio investors registered with the FBI are only permitted to invest in the sovereign green bonds under the different rules available for investment by FPIs in government securities. With a view to facilitate the wider non-resident participation in these bonds, the RBI will now permit eligible foreign investors in the IFSC to trade and invest in such bonds. The scheme for this is being notified. So what RBI wants to do this, that currently only foreign portfolio investors who are registered with the SBI are only permitted to invest in these bonds under different routes available for investment by FPIs in government securities. But now to facilitate the wider non-resident participation in these bonds, RBI has now decided to permit eligible foreign investors who are at the IFSC, that is International Financial Services Center, to trade and invest in such bonds. The scheme for this trade and investment in such bonds is being notified and it will be issued shortly. Second measure is relating to under the RBI Retail Direct Scheme. RBI wants to introduce the mobile app for the investors. Currently, the RBI Retail Direct Scheme enables the individual investors to buy securities in primary auctions as well as buy and sell securities through NDS order matching platform. RBI is developing now mobile app to further improve ease of access The app will enable the investors to buy and sell instruments on the go at their convenience. They don't have to open their laptop or the computer and go to the site and then do this auction. Then they can buy this security. But now they are developing the mobile app. On mobile app, you can do this now. Third is the review of the LCR framework. LCR means the liquidity coverage ratio. Banks covered under the LCR framework are required to maintain a stock of high quality liquid assets to cover the expected net cash outflows in the next 30 calendar days. Currently, banks are required to maintain this ratio at 100% on an ongoing basis. So it is a stock of high quality liquid assets to cover the expected net cash outflows from for the deposits, certain withdrawal. If it is coming, the bank should be ready to cover this through maintaining the stock of the high quality liquid assets, and this stock should be kept for minimum 30 calendar days on ongoing basis at 100% level. Now let us discuss why we need to review this LCR framework. Why RBI wants to review LCR framework? Because the recent episodes in some jurisdictions have demonstrated the increased ability of the depositors to quickly withdraw or transfer deposits during time of stress using digital banking channels. In case of US banking turmoil, we have seen that Silicon Valley Bank suffered this. Their deposits were withdrawn immediately as soon as the news spread, and the run has taken place through using the digital banking channels. And such emerging risk requires a revisit of the certain assumptions under LCR framework. In the today's economic times, it has been proposed, banks have represented that our funds lying in the CRR should be allowed for the coverage of this LCR. And so RBI is looking after this, their request of the, and accordingly will come out with the guidelines for the LCR framework in view of this incident that has been taken in the US and Europe of the bank failure due to the depositors' increased ability to quickly withdraw of their funds using the digital banking channels. Fourth is the dealing in rupee interest rate derivative products by the small finance banks. Under extant guidelines, small finance banks are permitted to use only interest rate futures for the purpose of proprietary hedging. RBI wants to increase their, expand their avenues. So for expanding avenues, these banks will be allowed to deal in the permissible rupee interest derivative products other than this also. Currently, it is only allowed in the interest rate futures, but it will be also allowed in the interest rate options when it will be notified shortly. Fifth is the enabling UPI for cash deposit facilities. Currently, the facility of cash deposit into cash deposit machines is available only through use of debit cards. Means anybody can go to the cash deposit machines and through debit cards they can deposit their rupee into cash deposit machine. RBI is now proposing to facilitate cash deposit facility in these machines through the use of the UPI. That means through UPI also anybody can deposit the money in the cash deposit machines. Sixth is the UPI access for the prepaid payment instruments through third-party applications. At present, UPI payments from the bank accounts can be made by linking a bank account through the UPI app of the bank or using any third-party UPI application. In order to provide more flexibility to PPI holders, the RBI has now proposed to permit linking of PPI through third-party UPI applications. It will enable the PPI holders to make UPI payments like bank account holders. So UPI access for the prepaid instruments will be allowed through now the third-party applications to provide the more flexibility to the PPI holders. Scheme will be notified shortly. Seventh and the last measure, distribution of the CBDCs through non-bank payment system operators. Currently, the CBDC retail is can be CBDC can be used through the CBDC wallets provided by the banks, and now RBI has proposed to make this CBDC retail accessible to the broader segment of users by enabling non-bank payment system operators to offer CBDC wallets. It is aimed at enhancing access and expanding choices available to the users, apart from testing resiliency of the CBDC platform to handle multi-channel transactions. Now, last, at the end, I'm going to express my perceptions on policy rate cut in near future. As you are all aware that currently the CPI inflation is at 5.1%, which is running above the RBI's medium-term target of the 4%. Further, RBI has projected the inflation for whole year for this financial year 2024-25 at 4.5%. So this inflation is not going to come down below 4.5%. So moreover, the food inflation also continues to exhibit the considerable volatility that is impeding the path of this inflation. Robust real GDP growth is also providing elbow room to the RBI to focus on price stability. In this regard, our RBI governor has also aptly said that 2 years ago, when the CPI inflation had peaked at 7.8% in April 2022. What is the problem at that time? The elephant in the room was the inflation. The elephant has now gone out for a walk and appears to be returning to the forest. The RBI would like the elephant to return to the forest and remain there on a durable basis. That is, it is essential in the best interest of the economy that the CPI inflation continues to moderate and align to the target on a durable basis. Till this is achieved, RBI's task remains unfinished. Our effort is to ensure price stability on an enduring basis, paving the way for a sustained period of high growth. As such, RBI is not going for a rate cut till the time inflation reaches to the 4% target and remains there on durable basis. So market should not expect that the rate will cut before December or before March. It will not be cut unless the inflation reaches to the 4% target or the growth almost come down from 7% to 3%. Then RBI may think over it. Our economy is not depending upon the US economy. If US will cut, then we will cut. RBI governor has already made it clear that our economy is not depending upon the US economy. If US will cut, then it is not possible that we should also cut. We are depending upon our domestic situation. We will take decision as per our domestic situation. If our domestic situation will not permit us, we are not going to rate cut. And for this, he has also quoted the example that when we have started cutting the rate, we have not dependent upon the US economy. We have started earlier, almost before the US has started cutting. And also we have kept the pause on this rate at 6.5% earlier than the US. So we are not depending upon the US for our decisions. We are taking decisions at our level. If we feel that our inflation is now stable and it is remaining for on a durable basis, then we may think over it to cut the repo rate from 6.5% to 6.25%. Otherwise, not, and it is going to remain there. In this regard, I would like to tell you one more story about our former RBI Governor Subba Rao. Once he was taking the video conference with all others, and during this video conference, almost all of a sudden, our governor has asked everybody participants that whether you would like inflation or the growth in the economy. So in the participants, there were two types. Audience were equally divided into two parts. One where the adult young people between 20 to 40 and another one 40 to 50. So those who were young were expecting growth, but those who were older people were expecting that it should be controlled inflation, and they were voting for the inflation. They were not voting for the growth. But the adult people who were dependent upon the salary, they want growth in the economy. They were selecting for the growth only. So this is the dilemma with the every RBI is facing, every central bank is facing, that whether they should go for the growth or the inflation. Our government always wants that the growth should be there and the RBI should not hike rate and इतना ज्यादा नहीं बढ़ाए रेट और उसको जितना हो सके उसको मिडल में रखे, जबकि इन्फ्लेशन अगर कंट्रोल में होता है तो फिर आरबीआई रेट को ध्यान में लाती है. नाउ thank you everyone for your time. We can now open for question and answer session.
Thank you, sir.
For more updates on finance and monetary policy, follow me on LinkedIn. Mail me at gkgunnani2@gmail.com. Thank you.
Thank you, sir. So we have some questions received.
Yeah.
How does RBI foresee the inflationary trends and impact on GDP during 2024 and 25?
Repeat, please.
How does RBI foresee the inflationary trends and impact on GDP during 2024-25?
This I have already mentioned in my
Slide.
cover that how it is arriving at the GDP estimate. It looks after four factors. That is bright outlook for the agriculture, consumption. What is our private consumption? Whether there has been increase in the private consumption or not, or whether there is a fixed investment there or not. External demand. All these factors are taken into the consideration for arriving at the GDP and the inflation.
Bank of Japan reserve rate is negative. Kindly explain how the rate can be negative.
Now it is positive. No, it was negative because their conditions, their macroeconomic conditions were very good. So they were keeping at the negative only. If their GDP growth is very excellent, why they should keep high rates? If our growth is at 11 to 14%, our inflation is also controlled. Their inflation is also controlled at that time. So they were keeping the rate very low. they were not required to give the high rates. But now they have increased by 10 basis points and their rate is now 0 to 1%. 10 basis points recently they have increased, looking to that to control the inflation within the target.
Okay, sir. So I think we are done with this question and answer part, and the participants have many questions. I suppose they can sir ask you, no? They can
Yeah,
mail
yeah.
you. They can ask you directly, no? So
Yeah.
please repeat sir once once more your mail ID and your contact details if they want to have any query. They can ask you. And we
Repeat.
will also upload the presentation in our BFSI portal also. The presentation.
Okay.
If the participant wants to reach you, so how they will reach you? If they
They
have
can
any
reach
query.
at my email has been given, no, gkgurnani2@gmail.com. They can reach through email.
Okay. So one more question, is RBI also considered the international price of crude oil for monetary policy?
Yeah. It is considering, while they are considering the inflation and GDP growth, or as also for deciding the policy repo rate. All these factors are taken into consideration. This they cannot tell. Email ID already given to you. That is gkgurnani2@gmail.com.
Okay, sir. Similar to green bonds, whether blue bonds are also there for development of ocean transport of passengers and cargo. Please share your views, sir.
At present, it is not considered, I think so. Other corporates may issue, but our government is not serious about these blue bonds.
Please explain SDF in detail, sir.
What is
SDF. Please
SDF?
explain it. Yes, in detail, sir.
Yeah, the standing deposit facility is for the banks parking funds with the RBI for the overnight. This rate is always kept 25 basis points below to the base rate, that is repo rate. Our repo rate is 6.5%, so the SDF rate is always linked to this rate, and it is kept on 25 basis points for this. This is the liquidity absorption tool for the RBI, and it is only non-collateralized, means RBI is not going to provide collaterals for this SDF. Earlier, under the reverse repo, RBI was required to provide the collaterals. So when the foreign exchange reserves or the FPI flows were increased, at that time the RBI was unable to give the these securities to the banks. So they were restricting, I mean, their liquidity absorption tool was not effectively working. So at that time, under reverse repo, the banks were coming to park their funds because they want to give the dollars to the RBI and want only rupee from the RBI. And whenever they were putting the funds with the RBI, RBI was too required to the provide the this securities to them. But now under this facility, SDA, it is non-collateral facility. RBI won't give any collaterals, but they can give better return than this under fixed reverse repo rate. They give the rate of 6.5% or 6.25%, 25 basis point less than the repo rate. So it is always linked to this SDF, and it is a very good facility for the banks because they are earning good returns on their funds with the, if they are not getting the funds for given for the credit, or if they are not going to interbank market, then they can come to the RBI, but RBI is restricting them that they should not come to the RBI frequently because for this interbank money market is there, and RBI's main operating target is to keep the repo rate aligned to the weighted average call rate in the interbank money market. So if they will come to the RBI for parking funds, this target won't be achieved, that to keep the repo rate aligned to the call money market, and call money market will collapse. So in order to keep the call money market alive, what RBI has suggested them, that you cannot come to the RBI frequently. If you are, if you want to go for funds, go to the interbank. Don't come to here for MFF facility, that is marginal trending facility. And even if you want to park the funds, you go to the interbank market only. You cannot come to here. So that is the SDF facility recently introduced in the April 2022. It is a liquidity absorption tool.
Expected repo rate in 24-25 will remain stable, or any upward or downward movement, and expected USD INR movement in 24-25, sir?
Means you want to know the exchange rate?
Yeah, some person has asked, ki expected repo rate in 24-25, will it remain stable, or there will be any upward or downward movement, and the expected USD INR movement in this year, that is 24-25?
You see, upward revision is almost ruled out, because it is not going to, because recently the inflation is coming down. So we can't expect that it will be upward revision. It will be downward revision, but unless the inflation comes in within the control, RBI is not going to take the chance of this cutting the rate. Even if the US will rate the cut, RBI is not going to depend upon them. They will see our domestic situation, whether it is has been achieved 4%, and this 4% should remain for 2 to 3 months continuously, or for the 6 months continuously. Then RBI may think for cutting it. Otherwise, it will remain at 6.5% for continuously. Even for June, I am expecting that it will remain at 6.5%. Even for August, I am expecting that it will be remaining at 6.5%. December, May, if the inflation is coming under control, going to less than 4%, then we can think over that RBI may cut by 25 basis points. Otherwise, for whole year, we have to keep only at the 6.5%, and we can't expect any rate cut. Upward revision is almost ruled out due to the stance of the policy, that is withdrawal of the accommodative policy.
So what is neobanks in the newspaper recently?
This subject is out of this, so I'm not going to discuss now. We will take it next time.
Yes, sir. Sir, there was no mention of Bank of China in the presentation slide of prime global banks. So your comments, please. Somebody has asked.
I'm not able to get your point.
There was there was a mention of Bank of China. I think he wants to have some glimpse of Bank of China in the presentation of this prime global banks of your presentation. So he
I'm
wants,
not aware about this.
Okay. So how monetary policy and fiscal policy are balanced by RBI?
RBI always consults with the government that whenever, because in the monetary policy, RBI monetary policy can control only demand conditions. For the supply condition, it has to go to the government, and it has to request that you can control the supply side bottlenecks. Otherwise, we won't be able to the control to the monetary policy. That is, inflation won't be our control in case of the supply side bottlenecks. So in this way, whenever RBI is not able to control the inflation, it also takes the help of the government through the fiscal policy they are taking, that you can take your action. You can control fuel prices, you can control food prices. It is also in your hands. So through the this policy, fiscal policy, in that way they are getting the consultation. Interlinked with the fiscal policy, both are complementary. Fiscal policy and monetary policy are complementary. If one is not able to take the action, government also requesting when the growth is coming down, then they are coming to the RBI that please, growth is going down. Can you bring the rate you're down? So RBI at that time takes the consideration. Yes, from 6.5 we will come to now 6%. That is during COVID times it has been taken that 4% we have kept.
What change you see in next 5 years in the monetary policy of RBI?
What?
Changes we can see in the next 5 years in the monetary policy of RBI?
Currently, I can't say anything about this because we have been asked to don't to give any forward guidance for this. So sorry, I'm
Yeah, I
not able
understand.
to.
Okay, sir. So we have received many questions, and sir, you have beautifully resolved all those questions. So
Okay.
with this, we have come to the conclusion of this question answer part. So now I would request PMA Dr. Aditi Das Gupta Madam, Joint Director ICMAI, for the vote of thanks. Madam, please.
A very good evening to all of you. Thank you, Gurnani sir, for such
Thank
a
you.
critical and visionary analysis of the MPC statement for 24-25. We are immensely blessed and privileged to have you for this show. Thank you so much.
Thank you. Thank you.
At the outset, I also thank our President CMA Ashwinji Dalwadi sir and our Vice President CMA BB Nayak sir and our Chairman sir CMA Chittaranjan Chattopadhyay and the board members of the BFSIB board for their continuous support and motivation. I thank CMA Dibyendu Roy, HOD and Secretary of BFSIB ICMAI for his support and supporting us for making this show happen. I also thank the CP department and the IT department to make it happen for this webinar. And also I thank the members, team members of the BFSIB team, Debabrata Das, Mr. Shantanu Pradhan, Mr. Rahul Arya, Indrakshi ma'am. Thank you all. And over to the Indrakshi ma'am for the final wrap up.
Thank you. So thank you, our speaker, sir, Gurnani sir,
Thank you.
for such a deliberate and nice presentation today. We are extremely hopeful that our participants are really enriched by your presentation today. And also thanks to our chairman, sir, and our whole team for their utmost support as always. So with this, we are concluding the program for today. Thank you so much. Good
Thank
evening
you.
to everyone.
I also thank the participants for the patient hearing.
Yes.
And thank you all for
Yes,
giving me this
obviously.
opportunity.
The participants, to all the participants also.
I think
Thank you so
participants must have enjoyed. Kindly forward me any feedback if you receive from this participant.
Sure, sir. We will mail you, sir. We will also upload the presentation in our BFSI portal also.
Yeah.
So with this, we have come to the close of this program.
Oh,
Thank you so
thanks a
much.
lot.